And I came out yesterday saying I think the melt-up is now in play, and I think this one will be the steepest of the rally yet, and you will go parabolic. So I'm calling for 6,000 on the S&P. I'm calling for 20,000 on the NASDAQ, 45,000 on the Dow. Those are unbelievable targets.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend David Hunter, a contrarian macro strategist with over 40 years on Wall Street. David, thank you so much for joining us today.
Yeah, hi Elijah. Thanks for having me again.
All right. Well, there's a lot to cover today. We've seen a lot of action in the markets, a bit of a pullback, which you actually predicted. And now we're seeing a bounce, and you're looking for this to be more than just a bounce. You're looking for this to be the final melt up you've been calling for a while. What I wanted to touch on first is the data we just got out yesterday, the inflation data. It just keeps on rising. And you've been talking about this as well, that we're going to see continued inflation, and it could go up even higher than this. But this 7.5% number, what is your perspective on that?
Yeah, I think it pretty much came in right on expectations, maybe a touch hot. And I know the markets responded immediately in a negative fashion to that, but I don't think the markets are really all that surprised. I think once you get the kind of the quick response out of the way, you're going to find that this was pretty much expected. And as I've said, having lived through the early 80s, my experience is that once inflation breaks out, it doesn't go back in the bottle very easily. So I'm not surprised by this number, and I expect inflation to remain pretty much in the elevated area for the next several months. In the bust, it'll come down, but I think before the bust, it's not going to be an easy task for the Fed to get this under control. You may see some pullback if supply chain issues get resolved, but we just had a shipping company come out in the last day saying, we don't expect the second quarter to be much different. We think second half we're going to see a more normal shipping situation. So there's hope down the road, but I don't think it's in the immediate future. I think inflation is just kind of fulfilling the expectations that we saw. And I think, as I've been saying, I think the inflation narrative, or I should actually say the tightening narrative that's been out there, where people are playing, who can have the highest number of hikes, wins the game. So we're going from 4 to 5 to 6 to 7 in this year. I think that game's probably going to top out here pretty soon, and you're going to see that tightening narrative reverse. It won't all happen immediately where they go from tightening to ease, but I think you can see over the course of the next couple months that the tightening narrative goes in the other direction, meaning that people are going to start worrying about the economy and saying maybe the Fed can't tighten that aggressively. I think it moves eventually to the point where I don't know what they'll do in March. They may have do one hike and it's done temporarily, or they may not hike in March and say we're going to continue to watch. But more importantly, I think the tightening is going to move towards, hey, we can't tighten like this, and that's what I think really helps propel the market higher. That combined with maybe a sense that Omicron's being put in the rearview mirror and that the opening up is happening again, that we're going to go back to a more normalized economy. Those two things, I think, are going to propel the stock market much higher.
No, we have seen this pullback, and a lot of analysts are saying that this is it. This is the crash. But as a contrarian, you often go against what a lot of people are saying, and you're often right. So what do you think, I guess if we back up here, what do you think caused this pullback? How did you see it coming? And why don't you think this is the final crash?
Yeah, we can go all the way back to early November. And at that time, it was pretty clear to me that the market was starting to struggle. There were some things under the surface that said this thing's going to have a correction. And I started talking about it then. It took about a month for it to happen. We had maybe a 5% correction, came down, and in some cases it came down close to my targets, and then very quickly reversed itself. And we had, a run up, came down again, and then had a year-end rally, a typical kind of Santa Claus rally. And I was told each time that it ran up that here's my melt up. I better get on board. I'm missing my own melt up call. And I fought each of those times it rallied and said, no, I don't think, it's done enough work on the downside yet. And then we got the third one's a charm. And I think in January, we had the much bigger correction, one that caused a lot more fear, which was what I was looking for. I wanted to see investors throw in the towel, and I wanted to see the bearishness come out. And we saw that in spades on January 24th. The baby was being thrown out with the bathwater, and people were getting pretty upset about how low this thing could go. And then it reversed, and we had a pretty nice bounce, particularly in the NASDAQ. And in the last week or 10 days, we've had it pull back again. And then yesterday, and frankly, the pullback in the first week after the January 24th drop, we had a retest. It didn't go all the way back, but we had a retest before we had that big rally. And so I feel like it's done its work on the downside now. Yesterday, it really came out of that and went much higher than people were anticipating. And I came out yesterday saying, I think the melt up is now in play. And when I say melt up, I really should say melt up leg, because we've really had a melt up from March of 2020. It's been a remarkable, almost 2-year rally now. But this is that final leg, and I think this one will be the steepest of the rally yet, and we'll go parabolic. So I'm calling for 6,000 on the S&P. I'm calling for 20,000 on the NASDAQ, 45,000 on the Dow. Those are unbelievable targets if we get there, because they're 30 to 40% up from here. And I think we could do that in the first half of this year. If we see that kind of a move in a few months' time, that's what a melt up is. It's something uncharacteristic, something we don't see very often. And I think people are throwing around the term thinking any big rally is a melt up. No, this is truly historic. So I think we've started it with the CPI number. You had basically a quick sell-off that went back and filled in the gaps from the gap up the day before. And it just looks to me like we can fool around a bit, but I think basically the melt up is in gear, and I think it's going to favor. I think it will be pretty broad based, so it will be both value and growth. It will be both large cap and small cap, and it will be, I think, very hard to resist. That's what investors don't realize, is they get so bearish in these sell-offs, and they're also sure we're near the end, that they're saying, I'm going to sit this out because I can't be that, I can't know when it's going to end. I don't want to get hurt. And that's wise. The problem is they don't know how powerful the psychology is. I think this broad-based rally is going to be very hard to resist. So those that sit it out when it gets started may be the very same people that kind of create the top by jumping in. So I just tell people, kind of know your own psychology, know your own habits, and either sit it out and truly sit it out, or get in early so you at least take advantage of it.
Whenever we do see a rise in the stock market, there's often a narrative that goes along with it. You've said that there will be a story here. There will be an extremely bullish story that, as you mentioned, will be extremely hard to resist for investors, and to remember that, no, this is just a blow off top. It's going to come back down. One of the things that's been happening recently is, as we've seen Omicron kind of wipe through the population, we're seeing a lot of people saying how this could be like the end of the pandemic. A lot of countries are removing restrictions. Could that be part of the story that might cause this for us to see this final euphoria and blow off top?
Yes, definitely. I think in fact that, along with what I call a reversal of the tightening narrative, are the two things that I think are going to be the primary drivers. So yes, as the sense kind of moves through the population that, hey, maybe possibly the pandemic is being put behind us, or at least for the next several months, I think you will see that kind of opening up mentality again. And it's probably going to favor things like airlines and hotels and, cruise lines and things that people have shied away from because of the pandemic. It's also going to obviously help restaurants and help the retail establishments, et cetera. So I think you'll see that. At the same time, you've got commodities breaking out, a supply chain issue that means there's a lot of industrial goods that have to ramp up to meet demand. So I think it's going to be pretty broad-based, as I said. And the other narrative that I think is going to help drive it is going to be a reversal in this tightening narrative. As I say, we've really been talking about Fed tightening since probably the middle of last year. And, we knew it was coming. We knew that inflation was breaking out. And it's been kind of hanging over the market all that time. Amazingly, the market kept chugging to new highs, but underneath the surface, a lot of stocks kind of just stayed in a sideways consolidation or downward in the case of growth stocks. If, in fact, that narrative is peaking here and beginning to reverse, which I think might coincide with that CPI number, ironically, people think that's the beginning of inflation worries. It may be the beginning of looking the other way now. It's discounted. And if the narrative starts to go the other way towards, maybe we've overdone it on the tightening worries, and then it keeps evolving towards maybe, not that we'll see actually ease, but the sense that, the economy is decelerating, we got to worry about that. The Fed may have to worry about that. If that narrative moves in that direction, that's very positive for the stock market. And I think that will help drive this meltdown.
You're very famous for saying that we're going to see an incredible crash in the stock market. It's been pushed a bit farther than you were originally expecting, but you're still looking for that about 80% downturn in the stock market. And we've talked about on this channel before that your forecast for this is really based on that we've been seeing about for 40 years or so, a secular bull market. And essentially it's a long-term trend you're looking at, not just short-term. And this long-term trend is showing that, we're looking for an 80% crash sometime soon. What do you think will then change that narrative that will cause investors to start dumping stocks?
Okay, first of all, it's really the 80%, and whether it's 70 or 80 or more or less, it's to me it's going to be larger than anything we've seen in the post-World War II era, and I think 80 is a good number. But it is the culmination, the end of a 39-year secular bull market. So it's a market that started back in August of '82. And this market, we've had cyclical bulls and bears within that secular market, but basically it's been driven by disinflation driving interest rates from, at one point, 15% on the long bond down to, below 1, 15% down to 0.4% on a 10-year. So we've had rates coming down that whole period, and that helped drive price earnings multiples higher, much higher. They started in single digits back in 1982, and now the market multiples, more in the 20s. So that's what really drove the bull market. And I think we're in that, the melt up is the last stage of it. The reason, timing is tough is because it's an end of cycle thing. It's not dependent on any specific time. It's not a trading type of an issue. It's saying when this cycle ends, it will end in a bear market that's bigger than any bear market we've seen in the post-World War II era. And before it ends, we'll have this final blow off in the market, what I call melt up. So that's, you had to see the melt up first, and it was clear to me the melt up was still ahead of us. Once we get through that, I think shortly after that, over the course of a couple months after that, you should begin the unwind. And I think the unwind will be faster than 2008-9. I don't use the word crash because crash to me is kind of, it infers that we're going to see it all happen in a couple months' time. I think it'll probably happen in stages. There'll be you could be down 40%, rally back half that, and then down another 50% or whatever. I think probably it plays out over 6 or 8 months, maybe. I think it will be relatively very fast. I mean, normally that kind of a distance you would take a couple of years, but I think it's going to be contained in less than a year. And it's, peak to trough 80% is obviously a huge give up of everything we've seen in the last many years. After that, we will have a recovery and there'll be a cyclical bull market. But I think the high water mark that I expect by the middle of this year, it doesn't have to be by the middle of this year, but when it is, the high water mark will likely not be revisited for decades. So I think that will stand as a high water mark in the markets for a long time to come. And then the bear market takes you way down. You can have big recoveries out of that bottom of the bear market and still not get anywhere near where you were when you started. When you go down 80%, it takes a long way to get back up to anywhere near the highs. And I don't think we're going to see those.
And that really, I know you don't really give any financial advice or any of that, but I think that just is such an interesting point because a lot of people have this buy and hold mentality. But if you're saying we could have an 80% crash or 80% downturn and not for decades come back to the peak. I mean, if people buy at the peak, that seems like, that buy and hold mentality just won't work.
Yeah. And even more than that, if you think about the kind of the popular approach that so many people have taken and what financial advisors have pushed for the last at least a couple decades or more, it's been indexing, right? You could outperform most managers by just being in an S&P index because of the nature of the market makeup that we've had for many years. And a lot of that is because the biggest component of why stocks were going higher was the interest rate declines. And that benefited a whole cross-section of stocks. So all you had to be was in the market. You didn't have to pick what companies were going to do the best or what sectors. So, and it was actually hard to be ahead of, group moves. So it's been really a period for 2 or 3 decades where index fund investing was the way to go. It was very low cost. It was easy. You didn't have to you didn't have to have a lot of knowledge of individual stocks. And a lot of people have been doing that. Going forward in the next cycle, the one that comes after the bear market, after the bust, index funds will have the opposite problem or the opposite situation where interest rates are going up and going up fairly steeply, and that will shrink PE multiples, price earnings multiples. So in fact, the very fact that we may not get back near the highs and the fact that multiples are going to be shrinking argues that it won't be so easy for investors to just throw their money into an index fund and not have to watch it and just buy and hold. In the coming decade, it's going to be much more like the 70s. And that will favor active management, selecting the sectors that will benefit from inflation, that will be able to outpace the interest rate increase and the PE multiple shrinkage. And that means stock selection. That means group selection will be very important. And so, because this trend has lasted for, probably 30 years, maybe more, it's very hard for people to realize that things change, and they kind of stay with what got them there. And that's the one thing I can say. I can't provide advice, as you say, but the one thing I would say is understand that we're going into a very different environment looking forward over the course of this decade. And it's going to be really important not to get caught in saying, well, this is how I've always done it. I'm just going to continue to do it this way.
Now, a contrarian investment for many people is precious metals, and you have some forecasts on gold and silver. Can you share with us those forecasts and what you see gold and silver doing amid all this chaos in the markets?
Sure. Yeah, you're right. It's a contrarian investment right now because gold and silver have disappointed investors for a number of months. In fact, probably a year and a half now. And they had a great run coming out of the March 2020 swoon, ran up into a peak in August of 2020 and have basically been sideways to down ever since. And a year and a half in investors' minds, particularly today, is like an eternity. So people are watching the market go up, up, and up, and they're watching their precious metals go down, and they just can't. There's a lot of hatred out there right now for precious metals. People give up. They've thrown in the towel. They say, I've bet on these for too long. Every time I think they're getting going, they rally for a little while, and then they go to new lows. I'm done. So you're seeing that kind of mentality. That is exactly the kind of mentality that creates bottoms. And I think we are seeing a bottom in both gold and silver. We're up off the bottoms in both, but they're very low relative to where they came from. And I do expect over the next 6 months that both of them are going to do very well. So I'm, with inflation being high and looking like it's going to remain high, that's good for precious metals. The dollar is just beginning to roll over after more than year-long consolidation, what I call a counter trend rally. The dollar came down sharply over 2 years ago, and then spent the last year plus in an upward consolidation, basically a little more than a 50% retracement, and now is showing signs of rolling over. I have a forecast on the dollar. It's currently 95 and change. It got up to 97. I have a forecast of it going down to 80. So if I'm right about that, and that's in this year probably, if I'm right about that, that should be wind at the back of precious metals. They will do well on a weak dollar. So my call for gold is 2,500 pre-bust. So that means not necessarily peaking out with the stock market, but certainly over the course of the next 6, 7, 8 months. Could happen faster, but you need some runway with that kind of a move. Silver, which is currently 23 and change, I think can get up to 50. And I'm pretty confident in these numbers that if anything, they're going to prove low. And then in the bust, they'll get hit again, with everything else, I suspect, but probably hit less than the market. I don't think they're going down 80%, or they might go down half that, or maybe not even half that. And then coming out of the bust, I think is really a time for precious metals to shine, no pun intended, but I do think you're going to see silver get up to $400 by the end of the decade. Gold get up to 10,000 easily by the end of the decade, and might even get to 20,000 in that time frame. So I think the metals are going to have their real day in the sun post-bust, but this move here is going to be pretty dramatic as well. So I see them as maybe the most attractive asset category out in the markets right now, because they did underperform for so long here while the markets were moving up. So it's really an attractive asset category that is mostly has been ignored.
It definitely seems quite an upside for precious metals. We'll definitely have to continue to track this with you, David. Thank you so much for your time today. Before we let you go, are there any last thoughts you'd like to add, and where can our viewers find you online?
Yeah, the one thing I will say is that everybody is bearish right now of bonds. The 10-year Treasury is hit 2% with the CPI print today, and I think there's a pretty good chance that I can't pick the tick that it reverses, but I think there's a pretty good chance that we're going to get a rally in bonds here very shortly and take the 10-year from 2% back down to 1.5%. As I say, we're going to see 1.5 before 2.5. I've had a long-held forecast of 2.5 when people were not nearly up at that high a rate. I think we'll see 2.5 this year, and probably by summer, maybe it takes a little longer. But before we get, we're not going from 2 to 2.5, in my opinion. I think we're going from 2 to 1.5 back to 2.5. So I think there's a rally coming. That too will be part of that, wind at the back of stocks here in the melt up. If you get, and it fits in with the, reversal in the tightening narrative. So I would just say, be careful out there, because there's, pretty much unanimous opinion on the street that interest rates are going higher. This is how the street works. They kind of extrapolate trends, and we certainly have had a move up in rates here recently. So just beware, it may not go straight in line from here. I think we could have a pretty good rally in bonds. In terms of where to find me, I'm on Twitter every day, for good or for bad. I get lots of people there kind of know me by now and understand my forecasting style and methods. And then there's others that will never understand my style and think I'm an idiot. So I'm on there every day, kind of not necessarily responding, but sometimes I do. You can find me at David H. Contrarian on Twitter. And then I do have an investment letter that if anybody is interested, it's a quarterly letter. It's all macro based. I forecast, I go into a little more detail on my forecasts. And that is by subscription. So if anybody has interest in that, they can reach out to me by direct messaging me on Twitter, and I'll give them details, cost and all that.
Fantastic. We'll put the link in the description there. And once again, David, thank you so much for your time, and God bless.
Okay, thanks, Elijah. You have a good next several months.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.